just that it's not an investment advice.
And we're live, gents. This is Value After Hours. I'm Tobias Carlisle, joined as always by my co-host Jake Taylor. Our special guests today are Marcel Schwartz and Matthias Hanauer. It's not investment advice, just so you know. We're just talking. We're just talking a paper today, formula investing. How are you, gents? Welcome.
Great to be
Thank you
here.
for having us.
So you guys, I came across you guys. Oh, I've known Matthias for a while, virtually. You guys have just completed a paper called Formula Investing. Why don't you tell us a little bit about who you are, how you came to work together on this paper, and what the paper's about?
Yes. Maybe I will start on that one. So Matthias and me, we met via my university during the studies. We were both at the Technical University in Munich, and during my postgrad studies, I took up the concept of formula investing, and there I came in contact with Matthias, and we teamed up basically to write a paper about it. And what we mean with formula investing is basically simple stock screeners that are aiming on outperformance even for retail investors. And what we did was we tested for very popular investing formulas the F-score by Piotrowski, the magic formula, which is probably known to most of the audience from the little book that beats the market, and consequently also your formula, the acquirer's multiple, right?
Good call, fellas.
Yeah.
Yes, definitely. And also the conservative formula from Conning, Blitz, and Van Vliet. And we try to bring all those formulas together on a unified framework, really, where we tested them on a extensive period of time. So we used US data from 1963 until end of 2022. And thereby we were able to compare them also against each other, but also test them for time. So we
Well,
really
let's just
tried
talk.
to.
Let's talk a little bit about the.
How would Zig do during the Civil War? I think that's what
Whoa, you
everyone
can't.
wants to know.
I can't say that. Can't say the.
Oh,
Can't say the tickers. Otherwise, I'm going to
Wires
put the whole thing
multiple.
through compliance. Let's talk a little bit about this. So the F score is the Piotrowski F score, and just remind us what is in the F score, or roughly how the F score works.
No, the F score is like a indicator of financial or fundamental strength. And it's like the sum of 9 binary indicators. And it's about the profitability of a company, the profitability growth, the liquidity, like if it can serve its debt, or also if it's issuing new shares or not. I think leverage is also included. I think it was, defined in the 2000, the paper came out, and it was like seen as the other side of value, yeah, but value measures like book to price, you buy deep value and do not look that much about the fundamental strength. So it was like complementary to the valuation part, having also something that is looking at the fundamental strength of a firm.
Did you have to adapt that for the data set that you looked at?
No, I think we followed was closely what is done in the original paper. Maybe some of the details we had to adjust, but we tried to stick as close as possible to the original formulas. But I think we had some adjustments like regarding the universe that we had tested the formulas. Of course, we updated the sample length, so we end in 2022. But also we want to really have comparability across formulas. But maybe Marcel can add a bit on that.
Yeah, so basically what we try to achieve is a comparable stock universe for all formulas. And I think Piotrowski was subsampling first for high book to market ratio stocks, so for value stocks, and used that subsample where he applied his 9 binary signals on. And to not use subsamples, but the same stock universe for really all formulas, we try to make a ranking for the formula scores, and for the F score we basically 50-50 weighted the 9 signals and the value factor. So just to make them a little bit more comparable.
What's the conservative formula? A conservative formula? Yeah, that's not one that I'm so familiar with.
It's inspired by a paper of my colleague Pim van Vliet. So to add, I work for Robeco. It's a global asset management firm headquartered in the Netherlands and also founded in the Netherlands. But next to my position there as a quant researcher, I'm also an affiliated researcher at Technical University, as Marcel said. And the conservative formula combines low risk, measured by low volatility, with momentum and what we call net payout yield. And this is a measure that also looks at dividends, but also at share buyback. So similar to MapPaba's shareholder yield measure.
And the magic formula, everybody will know, it's return on invested capital as one factor, and then EBIT, earnings yield on enterprise value, and then acquirers multiple as mine, EBIT on EV, or operating income on EV. So what were the findings, gents, just in broad terms? Marcel or Matthias?
Yeah, maybe Marcel can go.
I haven't gotten the question. Sorry.
Oh, sorry. What were the findings? Which one
was the best?
Yeah.
Well,
okay.
Without putting too fine a point on it.
Yeah. No, our key findings were basically in line with the books and the original findings, also for a longer time period. So we were witnessing monotonically increasing returns when we were sorting the stocks into decile portfolios. So the top decile portfolio was always able to outperform the broader market, and also the bottom portfolio, and also statistically significant, and had high return spreads, which were not explained by the CAPM alpha. That was a main finding, and we also found that it was not due to some magic, but more due to an efficient exposure to well-established factors. So momentum, value, size. So most of the returns were explained by well-established asset pricing factors. And on the second part of the research, we were taking a bit more of a do-it-yourself perspective, how we called it. So really the retail investor perspective, where we built long only portfolios of 40 stocks and tested whether they were still able to outperform the market also in the post-2000 period. And what we found there was that all formulas were able to outperform the market in raw and risk-adjusted terms. But we also noticed some performance decay, especially during the most recent years from the sample.
So all for the last 10 years didn't look as much like the 50 before them.
Yeah, you're absolutely right. So this is also something that you see for many factors in the literature. So you see typically good returns before 2000, and then you see sometimes like around 2004 that there's some decay over all factors. Probably has to do a bit that many of these factors were published just before, or that liquidity improved the markets after 2004. I think before the decimalization of prices were introduced around that period, that led to a higher liquidity, maybe also more hedge fund quant firms trading on these signals. So I think one of these lessons from our paper is that also these simple formulas probably need some continuous innovation. It's not that you once come up with this one magic formula and you don't have to revise it because it's just so magic.
And or you don't tell anybody about it when you publish it. Or you don't tell anybody about it, you don't publish it.
Maybe, yeah.
Well, I mean, what do you think? Is that because it's a phenomenon that it's not just these formulas. It's sort of, I think, most fundamental approaches to investing have struggled more over the last 10 years or so, or even 15 years. it's beyond sort of publishing and being disseminated. What do you think is causing that?
I think there's sometimes cycles also across factors. And I think you always have to be careful when looking at backtested results, because these backtest, also papers, they are backtests, are sometimes optimized. Researchers might look at 10 different ways how to measure one economic idea and then report just the best one. And therefore, maybe if they all maybe have the same expected return, but one was just lucky over the sample period, then you expect some decay for the best performing one. But there are also like sometimes people say, okay, this factor or this style is now dead. And typically, once this is set, the style reverses. And there we also have to be a bit looking at, okay, what is like the performance of a long short signal versus of a long only strategy that versus the market. Because for instance, in these long only strategies, I remember, for instance, 24 was or 23 was a good, or the average value stock was often outperforming the average growth stocks if you look at different universes. But most value strategies were underperforming the value-weighted market because you did not have included the Magnificent Seven stock. So there's a bit the differentiation that you have to do. But for instance, some signals like accruals was told to be dead, and afterwards this was written. We saw some come back in this kind of signals.
Accruals went away for a little while after the paper was published, but it seems to be it started working again as the signal over the last few years.
Exactly.
What has worked over the last decade in your experience, Matthias?
I think momentum has been over the last years a good factor. Also quality, yeah. Although there's the question how to measure it was strong in recent years. What has not worked was value, except maybe for 21, 22, parts of 23. So momentum and quality being the other side of value, this worked. But it's really, usually I would prefer blending good signals together, just because one single style will always fail, and by combining different proven factors, you enjoy diversification benefits across the factors. But it's also important to continuously innovate. Yeah, for instance, you have now so much alternative data. You have to be careful. Sometimes it's just an old measure in disguise. But you can also come up with alternative data, new techniques like machine learning, NLP, try to discover something new, shift more to short-term factors that you can blend in with your like slower moving factors. These are things that I think could be ways to enhance this investing formulas.
How do you think about quality? What's your definition of quality?
Well, I don't share what the proprietary definitions we use at Robeco, but we have one paper, I think it was published in 2000, and it has, the basic thing, everybody wants to have quality. Nobody says we have a chunk portfolio and we just hope, or we are sure that next month we can sell it as even more expensive. So everybody will claim that they have a quality portfolio, and therefore you would rather expect that quality is overpriced and the style would have a negative return. But what we found in our research was that there's a big variety in quality definitions, and those quality metrics that can predict also future earnings growth, these are also the ones that have or carry a premium. And this is sometimes not the definitions that you find at the top line of the income statement or at the bottom line, like earnings and ROA or ROE, but there's something more between, and you have to fine tune your probability definition. And maybe this is missed by the market.
It seems that quality's done very well for a very long period of time, and it doesn't seem to me that it's any more simple or complex than value necessarily. But why do you think it has persisted for so long?
Well, I think it's just maybe cycles, and we are in a quality cycle now, and it might be also that these markets, well, we need platforms and firms that are more profitable and can invest further in that technology, that they then grow and establish a position and have then again good profits. That might be something, this platform economy, but I don't have a definite explanation for that.
Let me give a quick shout out to everybody, and then let's talk about some of the things that you found in the paper that were a little bit unexpected. Petah Tikva, Israel, what's up? Tampa, Florida, Tomball, Texas, Lausanne, Switzerland, Gothenburg, Sweden, Toronto, Canada, Savonlinna, Finland. Are there 2 Savonlinna Finlands? No, just Valparaiso, what's up, Mac? Bremerton, Breckenridge, Toronto, Cleveland, Bellevue, Ballynamullen, Ireland, Camas, Boise, Dead Cat Gully, New South Wales. I hope that's a real place. Birmingham, North Miami, Stirling, Scotland, Jupiter, Florida, Adelaide. Good early start for you. Japland, Sweden, Mendocino, Tallinn, Estonia, and Dubai, UAE. What's up, folks? Thanks for joining us. As you were going through the paper, Marcel, what did you what sort of things did you find that were unusual? Anything stand out?
So basically, I found most of the results unusual because when I first read the books and read the results, I thought, okay, they might be a bit good to be true. So that was also part of the reason why I wanted to conduct the research. Is not only to prove the results, but more to find what's the catch. I thought, okay, maybe the time period was chosen wisely. Maybe it's due to the mythology. And really what I found most astonishing in the beginning, that it really worked for the extensive period and also without micro caps, and really for a investable stock universe. So what I found most interesting was that I couldn't find anything except for the performance decay during the last years that contradicted the original claims.
What's your investable stock universe? How do you define investable?
Investable for the paper was all stocks that were listed on one of the 3 major US stock exchanges. And then we excluded all stocks which were below the 20th percentile of NYSE stocks.
In size, in terms of size?
In terms of market cap, yes, exactly, yeah. So I think it was roughly 60% of stocks that we took out quite from the beginning. And then we also excluded all stocks where data was missing for in order to calculate all the metrics for all 4 formulas, and also financials, because most of the ratios were not.
On average, we had 900 firms. So it's close to the Russell 1000. I think in the beginning only 200, and then the peak was 1,100. So probably you would say this is for an US investor, an investable universe. A bit broader than S&P 500, but it's still good.
Yeah, so comparable to the Russell 1000. Did you look outside the US, or is it just US data only?
No, it was only US data for the scope of the research.
Maybe this is a follow-up paper testing international investing formulas.
Let's talk more broadly. What do you think investors who are approaching this problem now? What's a sensible approach for them sort of into the future? Does the deterioration in value mean that sort of, is that secular because it sort of looks a little bit secular in that data, or do you feel like it's cyclical? God, I hope it's cyclical.
I don't have no dog in this race, but yeah.
I didn't look at it in this paper, but I have other publication and inside articles where I look at value investing in general. And I think value had a strong period in the early 2000s after the dot-com bubble. During the dot-com bubble, or the build-up of the dot-com bubble, it also had problems. And when we zoom into this period, 2018 to 2020, then the similarities to 99 were quite similar. So value mainly underperformed because already expensive stocks became even more expensive, and already cheap stocks became even more cheap. And if you're investing in these cheap stocks and they're getting cheaper, then it's bad for your realized returns. But the more wide this valuation spread, how we call it, and I think you also shared some updates on that, actually it is it should be more promising to invest in these stocks. And we saw that this partly paid off in 21 and 22. And the valuation spread came down over this period. It's not as low as it used to be like in 2015. So I think we have still some lag to go from the valuation perspective. But it's also important to note that value, maybe even if it's like smaller returns in the past, or even have its neutral returns, it can be still a great diversifier to quality or momentum because it tends to be negatively correlated. And even if the premium is zero, it could, for instance, lower the volatility of a strategy. But I would expect like a positive return, maybe not as high as in the 1980s or whatever, but still I would expect a positive return on value. But you should blend it with also other factors and to lower the tracking error, because what we also saw in the paper, in the long run, these investing formulas give you a premium, but there are also periods where you really have the pain. And we measure this via drawdowns. And you saw the drawdowns around the global financial crisis, but also in 2018 to 2020. And we not only look at relative drawdowns, but we also look at absolute drawdowns. And we also saw that like the magic formula, acquirers, multiple, and F-score, they behave more similar, because they are essentially like value quality mixes. And maybe the conservative formula is the most distinct one because it has this low volatility element, which leads that you maybe lack in really strong bull market, but it gives you the best downside protection. And by further including momentum and net payout yield, you also hire a bit of the long-term premium.
Do you find it a little bit unusual that the low volatility generates lots of performance when it sort of flies in the face of the entire basis for the efficient markets theory that high volatility sort of, that it shouldn't do that. It's working 180 degrees against what the orthodoxy is.
Well, we should have invited Pim van Vliet for that. So he came up with this conservative formula. And he also provided great feedback when we saw the draft and gave a lot of input. So especially we want to thank him here. And I think this is really the core of all these factor models, that you typically people extended the CAPM with size, value, later probability investments, but they always kept like the relationship that higher market beta should lead to higher returns. But actually, it's the opposite. That the relationship is not linear. It's there's a little difference between low beta, low risk stocks and medium risk stocks, but there's really like a cliff where really like the stocks with the highest beta, with the highest volatility, they really underperform the market, and these are the stocks that you should maybe avoid.
I asked this question on Twitter a few years ago now, so I can't really remember what the answer was, but someone had done some research showing that the higher the volatility, the worse the returns. It wasn't Pim. It was a little bit before then, and I wondered when they were getting their Nobel Prize for economics, because I think they're probably due for one. But I don't think that there's been any movement in that direction, given that it breaks down the entire structure that's taught in just about every university in the world and has been for 50 years.
Well, there's some like with the 5-factor model, they somehow can explain the high minus low vol or high minus low beta returns in the time series regression, but I haven't seen any evidence, like for instance, that in a cross-sectional Farr-McBeth regression, that beta became positively priced. So I think there's still not convincing evidence that maybe including other factors than this relationship really holds.
What do you guys think about the markets generally? What are you watching? What are you keeping an eye on? What's interesting?
Maybe what Trump says about tariffs.
Is that the only thing that drives it?
At the moment,
it does seem to be that way a little bit in the short term, but it's recovered a little bit. Do you think it's recovered because he's reduced the tariffs a little bit? I mean, I don't even know I have no idea where we are in I don't even watch it. I don't even pay attention.
I mean, it is interesting to think. I think with China, it was 100 and something %, and now we're back down to like 70 or something. And you would have thought if we just took out that first 130 comment or whatever it was, and if he just said like it's going to be 70 out of the gates, you would think the market would crash, right? But instead, it crashed on 130 and then rips when it goes to 70. So it's all relative. It's all
haven't they settled around 3 or 4? I mean, I don't know. Maybe I'm imagining that.
For China, I thought it was still like pretty high. Oh, I don't know.
It's too confusing. It's too complicated. I have no idea. What do you guys think? What about you, Matthias? You don't give away any state secrets, but what's interesting?
Just yesterday, I looked with a colleague into earnings calls and how companies mention tariffs. Actually, the mentioning is at a record high. Maybe you have seen some graphs from Bloomberg or Financial Times that were mentioning that. But it's also interesting when looking at the sentiment, it's fairly neutral. A lot of companies are neutral on tariffs, say they can managing or just waiting. Some are even positive. Maybe they also see opportunities, no foreign competition maybe. But also the ratio is increasing that they become a bit more worried. But it's also similar. We saw similar patterns, for instance, in 2018 in this first like trade controversy with China. And it will be interesting to follow, but hard to predict. Yeah,
I've seen one of the retailers that I own, which I won't mention, so I don't have to go through compliance. But they sell what looks to me like completely discretionary stuff. But they've said some positive things about tariffs, and their last earnings results were pretty good. But I guess what I think is completely discretionary, my wife might disagree about what is completely discretionary.
Yeah, there's no discretion in the wife's budget, is there?
There are a few baskets that turned up yesterday that I was surprised that we were buying those, but I digress.
How often do you rebalance your portfolio?
Quarterly. Yeah, 2 portfolios rebalance quarterly back to equal weight. I've done some research on rebalancing. I think that Corey Hofstein had the best stuff where he said there's obviously a lot of timing luck in rebalancing. And if you miss March 2009 and you rebalanced instead in September of 2009, your returns are about half what they would otherwise be. So getting that rebalancing right is important. But then you also have these other considerations where if you rebalance too often, then I think there's maybe a little bit of momentum creeps into the portfolio. The longer you hold, the more momentum you get in your position. So monthly rebalancing is much more fiddly, and there's a lot more going on. But I don't know that necessarily improves returns, but it may take away some of that timing error. Have you looked at any of that? What do you think?
Please go ahead.
My colleagues had done a similar analysis as Corey. And I think looking at fundamental indexation and the dependency on when you rebalance. In general, this is true. I think if you would switch to a monthly rebalance schedule, then you also need to include some buffer rules. Because if you have like concentrated portfolio of 40 stocks, and it's like just 0.4% of the 1,000 stocks, or 4% of the biggest 1,000 stocks. So they will just change from one month to the other, especially if you include something like momentum. So it would definitely make sense to include some buffer rules, or really compare the expected alpha gain with the expected trading costs. But then it becomes less simple investing formulas, then it becomes really an optimization problem. But I think initially we looked at the results if we would only do an annual rebalancing, and I think they were fairly similar if I remember correctly, isn't it?
Yeah, I think they were a bit lower, especially for the conservative formula where momentum is a key factor, which is more of a short-term signal. So so overall, I think for all formulas, the results improved when we changed to quarterly rebalancing. I think, Tobias, you had yearly rebalancing in your book, right?
We had yearly, and we lagged the data by 6 months, and I think we traded mid-year as well. We traded in June, end of June, based on year-end data, just to avoid a few biases in the data. I had Mikhail Samanov on the program a few years ago, and he has this paper, 200 Years of Value, and he's also done a paper called 200 Years of Momentum, but he was looking at, there was quite a big drawdown in value at that time. This continues on to this day, but he was saying that momentum had a giant crash in 2009 with the GFC, global financial crisis. There was a quant quake in 2007, and through that whole period, that it had a giant drawdown. It seems that out of that drawdown, momentum's done quite well. Do you think that that value's had enough of a sort of drawdown to have a good cycle at the other side?
Yeah, I definitely hope so, and I also think there's reasons why you can be more positive on value. I think it's true, like momentum had this big momentum crash, particularly because it was after the global financial crisis, more long and low beta stocks and short and high beta stocks. And then in March, April 2009, that the market recovered, then you were short these high beta stocks, and they, like, it was with car makers, banks, more cyclical stocks, and they really were winning most, and that led to this momentum crash. But we also have done some research. We published on that my papers called Residual Momentum or Idiosyncratic Momentum. And there you see you can take out these time-varying beta bets, not only market beta, but can also take out other style betas. And then you get over the long run, a fairly similar return, but have much lower drawdowns and volatility. And these are examples of these kind of enhancements that we do and try to improve the process, taking out unrewarded risk, and similar with value. For instance, these formulas are all comparing valuation across different sectors, and maybe it's better to do more something like sector relative for valuations. Maybe you lose a bit of the premium, but also you also reduce tracking error a lot.
Jake, it's coming up to the top of the hour. Do you want to do your vegetables?
Yes, sir. Happy to do it.
Market fellas, 11. Oh, it's 32 minutes past the hour. No, it's 2 minutes past the hour. What am I talking about?
32 minutes in. So,
32 minutes in.
Imagine a river so polluted that it bursts into flames. And this isn't a metaphor. This actually happened. The Cuyahoga River in the summer of 1969. Kids were eating popsicles on Lake Erie's edge when just upstream, the water literally caught fire. So here's the mystery. How does a body of water like Lake Erie go from a regional jewel, the pride of the Great Lakes, to dead in a matter of years? And as Munger always said, you can learn a lot from studying failure. So, and resolving this mystery for us could help us understand other ways that we're likely to die and maybe avoid them. So for a little bit more background, Lake Erie was shallow and warm and nutrient rich and really perfect for supporting biodiversity and Midwestern economies. And then came the post-war fertilizer boom, and synthetic nitrogen and phosphorus flooded in, but not uniformly. The Maumee River drained this massive chunk of Ohio farmland right into the Erie. And algae then didn't just grow, it exploded. And the blue-green blooms, they turned deadly, killing fish, suffocating aquatic life. And this phenomena is called eutrophication. By the early 1970s, Lake Erie was officially declared dead. And how did all this abundance create collapse? Was it just pollution? Urban sewage, overfishing? The environmentalists pointed to the runoff. Policymakers blamed industry and greedy farmers. The public just watched on in horror. But something deeper and invisible was at play. And oddly, it might be a useful metaphor for understanding a key force in economics. So here's a clue. Richard Cantillon, Cantillon, was an 18th century economist that you probably skipped over in Econ 101. But his big idea was that new money doesn't enter an economy evenly. It's not as if it's dropped from the sky by millions of helicopters with bags of fresh cash that Ben Bernanke's just throwing out the window. It flows through existing pipes into preferred pockets. Those closest to the spigot, banks, financial institutions, government contractors, defense firms, large asset owners who benefit from inflation, venture capital and private equity who benefit from cheap money, really the moneyed class are the preferred pockets in here. And they all get to shop with the fresh money at yesterday's prices. Those furthest from the spigot, hourly wage earners, retirees on fixed incomes, anyone living paycheck to paycheck, they all feel the price increases, but just have to hope that some of it trickles down to them. And they're too far downstream, and usually they just get the higher prices and the hangover. So let's take this back to Lake Erie. Think of that upstream farm using supercharged fertilizers. Those nutrients don't spread evenly either. They gush in through the Maumee River, and the algae closest to the inlet get these first dibs on it. They bloom, they party, they dominate. Then they die, sucking oxygen from the room, and the fish suffocate, the whole ecosystem collapses, and eutrophication is this dark outcome of Mother Nature's Cantillon effects. And this system, the fragility, the systemic fragility, can be hiding in plain sight and even look like prosperity when the algae is in full bloom. So whether it's in money or nature, it's not just what gets added. It's also important to examine when and where. So unequal timing of inputs can create these feedback loops that look like growth right up until they implode. So policies, whether they're ecological or monetary, need to account for the where the enrichment happens, not just how much. And so like inflation, this eutrophication is a story of timing and power and undetected consequences. And really, nature is not exempt from Cantillon's ghost, and neither are we when we're running these trillion-dollar deficits. So there's your veggies for the day.
Good one, JT. Have you guys looked at central bank money printing and what factors benefit or get hurt by inflation and money printing?
Money printer go burr.
I looked at this claim that value just depends on interest rates. I think it was very popular 3 years ago, 5 years ago, something like that, around 2000, so when value was really suffering. And a lot of people said, yeah, with higher interest rates, the growth, the future earnings of growth firms are discounted more. Therefore, the valuation is lower when interest rises.
I think it was a very academic term that was used at that time, which was rates, bro.
And for some time, it was really like when 10-year was going up, value was going up, and when the yield was going down, value was going down. But when you look at longer sample periods, then we found really like zero relationship between value and rates. And it was very particular between this period, I don't remember exactly, 2018 to 2021. And also afterwards, it really broke down. So this was something we looked at. And I think we extended also it to the other factors. But of course, there are sometimes dependencies, but or correlations, let's say like that. But if you really have a view on interest rates, then I wouldn't like invest it through factors, but then I would buy long-term bonds or short them. Yeah.
Yeah.
I think Cliff Asness looked at it around that time.
Yes.
And he looked at lots of different, or his colleagues, I think, I think maybe Cliff did it personally as well. They looked at lots of different ideas, whether it was the shape of the curve for the rates, or whether it was the absolute level of rates, or the change in time of, and I don't think he could find anything that was robust that sort of explained the movements. What about rates and equities generally, rather than any kind of factor in equities? It's because it makes sense to me that as rates go up, bonds come down, but so should equity prices, because they're similarly, if you've got somewhere else that you can invest and get a reasonable return, if you've got a 6% yield on call, it doesn't make a lot of sense to be going out and buying stocks at 25 times earnings. What do you think?
I think this is more like the demand perspective. Sometimes higher rates also indicate like future economic growth, and then it's also good for equities, of course, if earnings grow in the future. My colleague Lawrence Winkles has a paper on it, on the time varying correlation of bonds and equities. But I have to be honest, I don't remember the exact results, but I think it's time varying of the correlation. And I think he explains some of the drivers that explain the correlation.
I think that there's this enduring idea that the equity risk premium, and I think that including the Federal Reserve in the US, tracks this equity risk premium and says that there are times when the equities earn over whatever the definition of the 10-year treasury bond or something like that. And when you when you get that premium, that means that equities are reasonably safe. But I think that John Hussman looked at it and he said that he couldn't find any relationship. There was a higher equity risk premium didn't mean greater returns to equities.
I think Cliff has a paper on it, or Norton is fighting the Fed model. Isn't it that one?
It could be. Hussman has one as well, but I don't know because Cliff done was fighting. Is that what it's called? Fighting the Fed model?
I think the main critique is that like 10-year bond yields are nominal returns, but earnings and future earnings are real. So if you have high inflation periods, then you also expect maybe that the earnings of the market will grow at inflation rates. And therefore it's not really like a fair comparison. I think this was the main critique, but maybe I'm also wrong.
I think
it doesn't make sense to me though, because it's like some businesses can grow their top line faster than their input costs, but plenty of them can't, and that's just as likely to hurt profit margins as it is to help. I don't know. That seems a little. I would imagine that in general, most businesses are hurt by inflation more than helped.
Yeah. I guess maybe it depends a little bit on your ability to control if you've got margins and you can control what price you sell with no, diminution in demand for your product.
That's a tiny percentage of companies
it's not very many.
Actually have pricing power, true pricing power.
Yeah, no, I guess we're agreeing, but I'm saying those companies probably like inflation or they don't care about inflation, but everybody else suffers. And that's one of the things that Buffett has written about, that there's this myth that you want an asset intensive business because the assets in the business go up, but it's the replacement of those assets that creates the problem. You can have 10 years of earnings based on depreciated assets, and then at the end of the 10 years, you have to rebuy that asset, and now you have to buy it at a much higher price, and all of those 10 years of profits that are completely an illusion because now you've got to spend that money again on much more expensive
CapEx.
Equipment.
Yeah.
I think that's the argument for why airlines have been such a bad investment category, because the planes get so much more expensive over time as they get safer, I guess.
Yeah, and you also have the barriers to entry are very low. You could go, I mean, it's also kind of a sexy thing to say you're starting an airline, and that there's psychological benefits that happen for somebody that's over and above the potential economics.
And the assets move around pretty easily too. You can get them from one location to another pretty easily.
Right.
What do you think about value being the beneficiary of that? I mean, value is more traditionally heavier industry, mining and heavy machinery and things like that. And that early 2000s value boom, it did come off the back of a period where value hadn't done very well. So the prices were all cheap, but it was also the beneficiary of China doing its giant infrastructure build, and so spending enormous amounts of money probably where it hadn't been expected, so pushing up all of the basic materials. And do you
commodity
think that,
boom?
Yeah, the commodity boom. Do you think that was?
Can I redirect the question a little bit?
Yeah.
Is there anything systematic in book to market that would make you select more of those types of industries, and then therefore perhaps end up with a bias that creeps in to the portfolio that would be built based on a price to book?
I would like to answer it a bit differently. Isn't it that?
That's good.
Yeah, there we go.
I think it's also more like what Tobias said at the beginning. Like, I think value after a period of bad performance, a lot of people have come up with explanation afterwards why it failed. And there was like this critique that value misses intangibles. And therefore, we have moved to a more intangible economy, less machine, asset heavy. And you have all these software companies, and the value of the software and the patents are not on the balance sheet. And therefore, value investing fails. And most of these papers, they always use just book to price. I think book to price is a great value variable. I think really undervalued, but a lot of people that just look at the standalone performance because it's a great diversifier with quality, with momentum. But I think if you think about the enterprise multiple, for instance, it uses EBITDA or EBIT. And if like all these intangibles produce profits So if they have value, these intangibles, then they should also produce profits. And I think then this critique is less valid. And I think this is always like these papers that mention these intangibles, they only look at book to price. But I think this is not an explanation why, for instance, cash flow to price or EBITDA to EV was doing not that good over this period, or only partly.
That was a better answer than the two questions.
And I think there are also ways to integrate intangibles into book to price, enhancing it, trying to consider human capital, brand capital, knowledge capital, these kind of things. But of course, then it's more complicated. You have to enhance the common academic definition, but I think there are ways to do that.
Why do you think? I mean, I know why book value hasn't really worked that well for that reason that it doesn't capture the intangibles, but it is more stable as a metric than. I mean, one of the things that you find if you're looking at, one of the risks that you use if you use a flow metric is that one of the positions that you're looking at has had an unusual flow. They've sold an asset or something like that. And so they look undervalued, but really on a more normalized basis, they're not. So book value would get around that problem, wouldn't it? It's more stable from quarter to quarter or from period to period. But no, it still doesn't work.
I think the other issue too is the LBO that happened in the last 10 years of companies borrowing and then buying back their own shares is also naturally lowers book value. Some companies even end up with negative book value eventually. So, that's of course seems like it might distort the signal of like what is, what's value, what's a fundamental intrinsic value. And if you're using book value as a proxy for that, it can get distorted by this kind of LBO effect.
Definitely, but I think you have maybe a bit of an US centric view. I think when you look, for instance, in emerging markets, I think book to price did very well over the last years. So it's also depends, and also maybe shows that you can do international diversification when investing actively. That maybe one factor does good for one region, but not for the other, and the other way around too.
Cliff Asness, when he looked at the performance of book value, and over the last few years, it's been one of the better performed strategies in the States as well.
The least value,
because it's the least value, yeah, because it's the one that gives you the least value. But how do we explain why the flow models like EV, EBIT, PE, EV free cash flow, or P cash flow, however you want to construct them, why have they struggled as well over this last period? When surely they should be picking up, they're picking up good companies that are generating flows and trading at a reasonable price relative to those flows. Why do you think they've struggled so much?
I think one of the explanations, or the best explanation that I could find, was really that the valuation changes were really explaining the negative performance, that expensive stocks already became more expensive, and these firms maybe they had high prices, they had good growth in the past, and maybe people just expected that this growth will continue for the next 5 to 10 years. But we often see that although they are also growing more in the future, not as much maybe as expected by market participants. So value firms that have been maybe not growing that much in the past, they surprise positively, and the firms that have been growing quite a lot and being really priced to perfection, they disappoint a bit the market.
Shaughnessy Asset Management had a paper where they broke down the performance of value and growth by exactly those metrics, looking at the performance of the earnings afterwards, and they found that the growth firms did deliver higher growth as you would expect, but they delivered less growth than the market expected. And as a result, they underperformed, and the value firms delivered worse growth than the growth firms, but better performance, better growth than the market expected, and so they tended to outperform. But why do you think that changed over the last 10 or 15 years? Were the growth firms delivering better growth than they had than the market expected even?
I think we looked at it in one small insight, and then also in unreported results, I looked into like 3 subsets, like if the behavior has changed, and I found little differences actually. And But of course, these are still 10, 15-year sample periods, even in the 3 sub periods. And it might take some time until the market prices it fully. And I think sometimes we saw some, like, let's say, corrections, rotations from growth into value in 21, 22. And I think it's also different, as I said before, the average value stock was doing good or great, and even better than the average growth stocks, but just by the dominance by this like magnificent 7 stocks, this was a bit hidden, because value strategies were missing out on these 7 stocks.
So it's maybe we talked about this a little bit, Toby, on like, I did a bit of a mea culpa on like, how did I miss Google? And you know, we're talking about base rates and the ability of large companies to grow and continue to grow at rates that just historically had never really been done before on a consistent basis. And we ended up with that turns out that was not really that wasn't the actual base rate for those companies. Like the real base rate was quite a bit higher than one would have predicted. And
yeah, I was going to, that's like a Mobison or Credit Suisse, wherever it came out of, where he looked at the base rates for those biggest companies, and they were defying the odds at scale because they were different types of businesses, I guess. Like previously it had been an oil company, which is sort of limited to the amount of oil it can pull out of the ground, whereas the
amount of assets that you needed to create that revenue just kind of grew at a relatively, you need like a pump, and you need a train to move it, and you need a refinery to turn it into something.
You actually have to do something with it.
Yeah, these guys were able to, the returns on scale were just increasing, perhaps because of network effects and just incredible businesses.
There's another thing that we haven't discussed, and that was Michael Green's passive flows, which is, what do you think about that, Matthias? Is that something that you've looked at, the influence of passive flows on the biggest companies in the market?
The indexation and
so this inelastic price hypothesis.
Yeah,
I have read it only. I think from the flows perspective, you think like big stocks with more market liquidity, better market liquidity, also then gets a higher share. That should be fair. But he finds empirically, I think, some results that don't fully support that. Yeah, but it can be temporary price pressure, and then this comes down. I don't know that really exactly. One explanation that I heard that could also support it, that the most expensive stocks profit from indexing, is that all the stocks that or all dividends distributed from the stocks are reinvested not in the stock itself that are issued as dividends, but in the index, and therefore you see some like distribution from the smaller stocks to the bigger stocks on average, because maybe the smaller stocks have higher dividend yields. This is one explanation, but at the end it pushes up the valuations, and at some point you would expect this gets repriced. And
I think, to be fair to those businesses, though, like a lot of them have, they might be a little bit stretched, but they're not massively overvalued. They are, like, the businesses are reasonable, like they are that much bigger than the other stock. And there was one thing that I hadn't realized until the pandemic, when the airline stocks got beaten up, how small the airline stocks were relative to the tech stocks. I think this might be the bottom of the pandemic.
Market cap for ants? What are we
Yeah, well, the airline stocks had like $30-50 billion market caps, and Google was making, like, that's a quarter of cash flow for Google. Google could buy an airline stock every quarter if they wanted to. I mean, it's probably more than that now. You know, they are the right size for their market cap. Like, they are that much bigger, and the flows for those size stocks are probably, they're not overblown. They're not just receiving giant flows because the market cap is bigger. Like, the businesses are that much bigger too. So I sort of don't really see why that should then create. I understand why it creates a lower valuation for the companies that don't receive the flows, but then I don't see why you can't take advantage of that as a value investor of those. Why those smaller companies that don't then generate outsized returns as a result, because they should be on a fundamental basis, they should be growing at the same rate. The same effect should be happening. It's just now it's happening at a lower valuation, so they should be generating better returns. That's the thing that I found most confusing about the whole of the last 10 or 15 years, that if quality is a good metric, then it should get bid up and it shouldn't continue to generate these excess returns. And if value is a bad metric, then it should be bid down and it should start to generate better returns. Like that's the nature of this business, that if something gets missed or left behind, then all of a sudden it starts working again because it's so undervalued. But that hasn't been the case.
Well, you just have to survive long enough for that to.
Well, you have to survive that long.
Well, there's also a reason maybe why you want to include other factors next to value and quality, like momentum, where you can profit from these trends and maybe that are not fully fundamentally explained.
I mean, the two factors that you want are US listing and a big market cap. That seems to have been the thing that drove returns over the last 10 or 15 years.
Yeah, I think size has been not like usually small cap, so equally weighted indexes were outperforming market cap indexes, but over the last 10 years it was the other way around. But also people are predicting now that might reverse and making the case for small caps. I think as an investor you should have allocation to small caps just because they are in the market portfolio, and maybe due to the also the performance of small caps versus large caps, for instance, can be a lot explained by changing in valuations, but not just by operating performance. And of course, within small caps, there might be also like opportunities to generate alpha because you have just thousands of stocks that you can invest in and find. Yeah.
Phil Bock, who's a friend of mine, had this index, or he had an ETF called the reverse ETF, where he took, if you take an equal weight that outperforms the market cap weight, just because it's sort of quasi value, I guess, because it's sizing up the smaller firms a little bit more. And so he took that one step further and reversed it. And he said, to the extent that the market capitalization exceeds equal weight, we'll then apply that as a discount to it. So they're going to be the smallest in the index. So it'll be the exact inverse of a market capitalization weighted index. And unfortunately, he launched it just in this period of time where it's been completely dominated by size, and it just didn't work very well and didn't attract any assets. But really, it should, like, I mean, it's a quasi value index in the S&P 500 that should have, it's like a dogs of the Dow or something like that. You're sizing up the things that are the smallest. It didn't work. It seems like it's an unusual period of time in the markets. So the only question I have is, when does it reverse? Tell us, Matthias. Tell us, Marcel. When does it stop? What's it going to take? Is it a big crash?
I think there's a 60% chance that it will revert.
40%.
Yeah.
All right, thanks, fellas. I think we're coming up on time. If folks want to follow along with what you're doing or get in touch with you, what's the best way of doing that, Marcel?
Via email at marcel.schwartz@tom.de. I think that would be the best way, or via LinkedIn. I think that's probably the best ways to reach me.
And Matthias?
I'm both on LinkedIn and on X, both with Matthias Hanauer. And you can also follow my research on S07, where I have a profile.
I will post the paper under this podcast, and Matthias is linked up in the tweet announcing this one. JT, any final words?
No. Nothing to add.
Marcel, Matthias, thanks so much for joining us today. Once again, folks, thanks so much. We'll be back next week, same time, same bat channel. See everybody then.
Thanks, guys.